India's corporate bond market, a decade of transformation and future outlook. This is the first panel discussion for the day. The session will focus on the key aspects of globalization and integration of Indian corporate bond market. Projection for the financial year 26 and beyond. Now, what we are going to cover in this session is what are the key indicators for continued growth, strategies for better price discovery, especially in the OTC markets and for lower rated bonds. SEBI's role in balancing transparency with capital raising, often benchmarked against global standards, efficient market ecosystem for trading, and robust market infrastructure. We'll also cover how to overcome stunt growth, challenges and opportunities, impact of interest rate cycles, inflation, and economic growth, data aggregation for comprehensive analysis. Now, before we start the session, I request people at the back and the front to kindly take your seats. We have a dedicated networking lunch session. I'm sure we'll get a lot of time for the networking there. Everybody, please. People in the front rows, may I request you to please take your seats now? Thank you. Thank you so much. So if you could please take your seat now. We are all set to start the panel discussion. Thank you so much. Now, this is going to be a very interesting session, and I'd like to invite the session moderator on stage. Please give a round of applause for Dr. Shikha, Bagai, MD, India and Mauritius, Vistra Group. Round of applause for Dr. Shikha, please. Thank you for joining us. On the panel, we have Mr. Vijay Chandok, MD and CEO, National Securities Depository Limited. Round of applause. Next up, we have Mr. Ashok Sharma, DMD, CCO and CSO, State Bank of India. Next on the panel, we have Mr. Girish Lakhotiya, MD, Prachay Capital Limited. Last but not the least on the panel, we have Mr. Priyashis Das, CEO, Northern Arc Securities. Round of applause for Mr. Das, please. Dr. Shikha, I request you to please start the session.
Thank you. Thank you for the introduction. Good morning, everyone. Very warm welcome, and hoping you enjoy the discussion and the conversation for the next 40-45 minutes. Please feel free to step in and ask your questions, and let this be a conversation between all of us here and not just between the panel. Just a 1-minute context. Indian corporate markets, we've heard a lot about the whole growth being on an upward trajectory. Last year was phenomenal, a growth of 13.49%. And if you just look at the gross issuances, then the growth has been about 150% over the last decade. Depth and balance continue to be the challenges. And what we don't talk much about, we haven't talked about it today, is the whole skew in favor of entities that carry implicit state guarantees and the crowding out. The other trends include institutional players like insurers, mutual funds, pension funds playing an increasingly important role. So for our conversation for the next 45 minutes, we will explore various dimensions of our market. We are honored to have decision makers and practitioners on the panel today to give their insights and views on some of the deeper dimensions of the market. Starting with you, Mr. Chandok, the question first for you. Looking at the recent SEBI initiatives regarding unlocking liquidity and enhancing price discovery, particularly in the opaque segments and lower rated corporate bonds, how do you see these helping in the development of the market, especially corporate bond markets, sir?
Thank you very much, Shikha. I hope I can be heard. Yeah, thank you. Thank you, ASSOCHAM, for inviting me on this panel. Namaskar to all of you. I'm tempted to, before responding to this question, to dive a little bit into my personal past. I've been a banker for most part of my life. And there I was running the SME business So when I joined the SME business, I said, let me understand what the problems of SME are. And I delved down into deep papers of research that were done prior to me taking over, and that was many, many years ago. And they said the number one problem was availability of finance. It's been 20 years since that particular incident. And if you dive in and look today and ask the SME, what is your biggest problem? They will say availability of finance. So some things never change. I think in the earlier session, the SEBI member also pointed out, 25 years back, we've been talking about bond market development and reform. Today also we are talking of. But I think a lot has changed in the last, several years. And for a country and economy like India, imperative for bond market to grow. All stakeholders, be it the market participant, be it the regulators, policymakers, all of them have been talking to various stakeholders to understand issues and solve them. And I think finally we are seeing some good traction coming, particularly on the retail side. There were some numbers shared in the last session, but what is interesting about those numbers is that just 1 year back, the total outstanding, bond issuances were about 47 lakh crore, which as of 31st March has increased to about 53.5 lakh crore, as was pointed out, which means it's more than or about 20% growth. So 12% in the last decade, but the last year has been 20%. And in the 3 months that have happened, it has crossed about 55 lakh crore. So the growth seems to be really coming and clipping at a much faster pace. So what's happened? What are the reforms? And to your point, so first and foremost, I think some of the issues that SEBI has been addressing in a very proactive way is making liquidity, price transparency available. Some of the initiatives in this context has been the OBPP, and we spoke about that in the last panel as well. So these are platforms which have brought buyers and sellers to trade in a regulated environment, not trade, but buy and sell in a regulated environment. And that gives confidence, that gives the little more depth to the market, that gives access, that gives better price discovery. And we are seeing a great growth of investors on those platforms. There are some 40 odd platforms already registered with SEBI. The fact that it is registered and regulated itself gives confidence to the investors that they are dealing in a trusted ecosystem, and I think that's very important. In places where there is less liquidity, then you have these RFQ platforms, which are an exchange promoted platforms that particularly in cases where the liquidity is low, then, at a price, the investors can give an offer. So, that if you want to buy or sell a certain bond, it is possible to buy, provided, you're ready to go down or go up to a certain level of pricing. So, liquidity is made available. There has also been efforts to reduce the face value. 1 lakh earlier is now down to 10,000 rupees. So, clearly the attempt is to bring more I would say liquidity into this. The liquidity facility window that has been provided where issuers can provide an option or can do a buyback, and the option is available with the investors whether he wants to take it or no. So at least there is a liquidity in pre-specified periods of time that is available for him. Then the fund that has been created, that is in case of emergencies, market dislocations. It's a Cat 3 fund which is actively participating, and this number is growing. The corpus of this fund is growing. So a number of initiatives have been unleashed, and I think in a market like India, we are still a WIP. So I'm sure as we go forward, things will keep developing from a regulatory side, from a customer information and knowledge side, and risk appetite side to deepen the market.
Sure. Thank you. Mr. Sharma, coming to you. As a leading institutional participant, how does SBI view its evolving role in deepening India's corporate bond market, particularly in supporting lower-rated issuers and longer tenor bonds, while balancing risk and return?
Thanks a lot, ASSOCHAM, for having us here. I think a lot of numbers have been repeated, but before I come to the point that you raised, let me repeat the numbers once again. So we all know the market is around 20%, but who are the competitors? So All India Scheduled Commercial Bank, those are the competitors, then commercial paper, CD, NBFCs. So if you look at the numbers, if you break up those numbers, so ASCB outstanding is roughly 182 lakh crores around March 25. Then NBFC around 45 lakh crores. Since banks also lend to NBFCs, so roughly 16 lakh crores have been lent by the banks to NBFCs. So if you reduce from 182 to 16 lakh crores, comes around 166. Now add this 166 to 45, so 171, 211. CPCD market is around 11 lakh crores, so around 211. And the 11, so 222 roughly. Bond 54. So we come 277, 278 lakh crore. So 277, 278 means roughly 10% is 27, we are 54, so 20 lakh crore. So we are competing with those players, NBFC, banks, CPCD. What are we doing so that the issuers feel comfortable in coming to the bond market rather than going to the banks and the NBFCs? So look at some of the sectors, for example. Suppose there's an airport which has a 70-year concession. Whether the airports are coming to the normal bond market? If not, why are not they coming? So the way I look at it, the bond market is still run as a trading book. So you all are looking for that, okay, it is a AA, AAA rated, so I'm happy. Can we develop the ability to understand the underlying asset behind the issuance? So if it is a airport, it is a, for example, a port, roads, lot of such sectors are getting privately placed because probably the larger segment of the bond consumers, for example, the mutual funds, etc., they have not developed the ability to assess those requirements. My sense is we need to develop those abilities. So for example, if you go to Australia, most of these kind of assets are not rated there. And most of the market is able to absorb those kind of bonds. That means if we have to move beyond so-called the BBB and below, we need to develop those abilities so that those issuance are good issuance. If you look at, for example, the upcoming Noida airport, the guy sitting in Zurich knows it is a good asset. They have come. You look at the Bangalore asset, the guy sitting in Canada knows it is a good asset, they have come. So you will find many of those kind of assets, lot of foreign investors are happy to come in without bothering for the rating. Why not our own institutions are able to understand that, develop that abilities and participate in the, see, bond issuance is happening, for example, Bangalore happened, bond issuance. But still, the banks who are comfortable in understanding these things are subscribing. The institutions who are not comfortable in understanding these things are not subscribing. So probably we need to look at that part, that how do we develop the awareness in our stakeholders who are better able to understand. This is one piece. Second piece, again, coming back from the competition point of view. When the players are coming to us, they want, okay, please give us a flexibility that every year they can prepay without any prepayment penalty. So can I develop bond structures like that with so much of flexibility? Callability? Because typically bonds are being seen as, okay, you're stuck with the bond for a particular time. Many times, many of the players would come, please give me every quarter, depend upon, so you can negotiate. So those kind of flexibilities are available to them in the bank loan market, which are not available to them in the bond market. One more data point I was just seeing. So are we really off the market or not? So I'll just give you one data point. It is a corporate bond versus bank lending market. In USA, bank lending is only 23, corporate bond is 76. But if you come to the other geographies, UK, corporate bond market is 26%, Euro 11.60%, Japan 19.40%, China 7.20%, India roughly 22%. we are not off the market in terms of other than US. So we need to probably enlarge the whole basket. Once we enlarge the whole basket, then probably this will go much faster.
Thank you. So one fact here is that more than 80% of the bonds by volume are issued by entities that are rated AA or above. A concentration that pretty much underscores reliance on the relatively small universe of credit-worthy borrowers. And that brings me to you, Mr. Lakhotiya. As a private capital facilitator, what challenges do mid-sized and lower-rated companies face for accessing the corporate market?
Thank you, Shikha ji. I have been working with smaller companies and real businesses for the last 15 years. तो मैंने काफ़ी ज़मीनी स्तर के ऊपर काम किया हुआ है छोटे छोटे बिजनेसेस के साथ में उनको डेट फाइनेंसिंग अवेलेबल कराने के लिए. And as a first generation finance entrepreneur, I led my company to a public debt issuances without practically any external support. So I have experienced this system myself. And what I would like to say is, we have been quoting a lot of numbers during the day. But to summarize the problem of Indian corporate bond market, we need to look at only few numbers. 95% plus issuances are from top 2 rated companies. And 99% of issuances are private placement. So this is an exclusive club which we have created, where selected few are raising money and only selected few are deploying money. So this is the biggest problem. अब हमने एक्सक्लूसिव क्लब बना दिया है तो हम कैसे परेशान हो सकते हैं कि एक्सक्लूसिव क्लब बढ़ क्यों नहीं रहा है. अगर हम लोग कंपेयर करेंगे वेस्टर्न मार्केट से तो वेस्टर्न मार्केट्स में जो डेफिनेशन है जंग बॉन्ड्स की, दैट इज एनीथिंग विच इज बिलो इन्वेस्टमेंट ग्रेड, which is below BBB minus. But the situation in India is anything which is below AA is treated like junk.
Yeah, there is no liquidity. It's difficult to get out.
So that kind of untouchability I have personally experienced. I believe somewhere it starts from the regulators because they have put credit rating as a condition of not investment or investment for a lot of big institutions, big players who can shape the market. Regulators have given this restriction of not to invest below AA. Even the wealth distributors, they don't want to take anything to their investors which is AA. They assume that their investors do not have a demand for it, which is not true. But they believe that they do not have the credit expertise of analyzing which bonds are good, which are not good, and hence they are scared of their own brand name and they are not willing to take anything which is below AA. The online platforms, some banks have said us that we will not house on our online digital platform a public issue which is below AA. When the regulators have cleared us for accessing public markets, how can you create further barriers to restrict the entry? Forget that. Even my friends, who are running family offices, who know me personally, they say that, our investment charter doesn't allow us to invest anything below AA. अब आपने इतनी बड़ी untouchability करके रख दी है एक कैटेगरी के लिए. And anything who understands a little bit of credit rating would clearly tell you that unless you reach a certain stage, certain scale of operations, you won't get into the A club. So what we are practically saying is the doors of debt capital markets are restricted for smaller players. And this is the major part of the pyramid. And these are the companies who really need support because the traditional banking system cannot meet all their finance requirements.
And there is
will
risk
be certain
appetite.
Structured long-term requirements for which you need bond support, bond market support. So I feel, these are the challenges which typically a mid-sized company accessing debt capital market faces right now.
That's a very important point. We are repeatedly hearing the same thing. On the one side, credit expertise, assessment expertise not being available, the market being extremely reliant on credit ratings as a single metric. And on the other side, a whole gamut of funding requirements which are not met. Exclusive club, and thank you. I think that's a great way to describe the situation. Mr. Das, coming to you. Northern Arc has been pivotal in bridging capital markets with underserved sectors. What structural or regulatory shifts are needed to deepen the market's access for NBFCs, MFIs, and small originators?
Thank you. Thank you, Shikha, for asking that question, and thank you, ASSOCHAM, for having me here. I want to address some of the elephants in the room, and it's very important. Firstly, I never dealt in bonds. So like Girish, I'm a wealth guy. I've been a wealth guy all through my life. And I was literally afraid to take a bond to my client because of the opaqueness, because of the difficulty in delivery, not knowing how to get the managed wealth transaction done. But I think, to your point, to Vijayji's point, there have been a lot of development in the regulatory framework, right? Making the bond accessible at 10,000 is one step. But when you look back and when you step back and you look at how has it impacted the NBFC? Okay, so me as a originator, when I go to an NBFC and I say, look, let's retailize your bonds. Let's bring the face value down from 1 to 10,000. His first question is, how do I serve 40,000 debenture holders? How do I serve, queries coming from 2,000 retail investors? Now, who answers that question, right? You want to retailize, but is the market ready? The answer is no. The second point, which is very important, is to talk about any market which has to grow because of standardization, because of transparency, because of how much you know about one issuance and how much can you offer as information to the investors and investor education. So I was in SEBI a couple of days back. I don't know how many of you know it. So we were talking about financial literacy at a Gram Panchayat level. I don't know how many of you have actually gone to the Gram Panchayat website. Do that. Go to your taluka, which you will know. Go to your village. Go to your block. You'd be surprised to find that there is information at the level of age, gender, what development is happening in that taluka. But there is no information on financial literacy. So SEBI wants to take it to the grassroots. Great option. But there are landmines that we need to cross together across all market participants, whether it is, and again, come back to the same thing, standardization, transparency, and then liquidity, something that Girish talked about. If you want to trade a BBB A bond, you will not find a buyer. If you don't find a buyer, why will a retail investor come in? And retail, if defined by our Viksit Bharat, is going to be 60 crore middle-class Indians. Same class of people who fueled India post-liberalization. How do we serve that genre? That is the question to answer, and that's the elephant in the room.
Wonderful. I like the candidness with which the discussions are progressing. Coming back to you, Mr. Chandok. We spoke about online bond platform providers. You spoke about the platform. How will the rise of OBPPs increase retail participation and democratize access to the corporate bond market?
Yeah, what we are seeing here is OBPPs are doing exactly what the digital platforms did for equity markets maybe 7, 8, 10 years back, and which really took off in a dramatic way during COVID, right? So very, very parallel equivalent one can draw. So first and foremost, the number of players who are offering this has been growing. As I mentioned earlier, there are some 40 of them who are registered as on current date. What do? You can actually, they give you access. I think that's the first important thing. And giving access is that, okay, you don't need to do any paperwork. The whole process is digitized. So the process of onboarding, opening accounts, getting yourself registered, making yourself eligible to buy a bond on a platform is all digital and simplified. No paperwork. So that brings in ease. The second is affordability, right? Even if you want to buy a single bond, it is possible to do that on the platform. The stuff that he spoke about in terms of how do I, handle large volumes, etc. Digitization technology is, one way to address that. Of course, there are many, many other dimensions to the point that he mentioned, which still need to be addressed. But simply speaking, they're giving him an opportunity to buy a single bond. Then knowledge, we spoke about that as well, knowledge and information. So through their sort of combined portal, Bond Central, there is a lot of information that is being disseminated. This information, incidentally, NSDL, the organization that I represent, is feeding through our India Info, Bond Info platform. And information is coming from two angles. One is the NSDL platform, which provides things like rating, terms, payment dates, and so on and so forth. So anything that you want to know about a bond in terms of credit rating, when is it due, what details about the issuer, what are the objectives, what is the maturity period, what are the due dates, and so on and so forth. All that is transparently available at the touch of your fingertips through this platform, Bond Central, and also on the NSDL India Bond Info platform. But in addition to that, it also takes feed from the repository, the bond repository, which is coming from the exchanges. So you get to know what is the volumes, what are the last traded prices, buyer, seller details, and so on and so forth. So it gives you a combination of fundamental information and more technical information, if I may say so. So access to knowledge. Then you have the full range. So everything that you may want to buy, tax-free bonds se leke, rated high, rated medium, and so on. Of course, there's nothing called anything below rated high in the Indian market, but it's either A or AA by and large. Some OBPPs do offer relatively weaker credit paper. So it's beginning to happen, what was being mentioned by Girish. So availability and access, knowledge, all these things, plus the fact that it is regulated by SEBI, I think gives a lot of confidence to the investor that yes, it's a trusted platform, there is some method to this whole thing, there is harmonization of data flow. The interpretations are now all harmonized so that, taxonomy is sort of equivalent across. The way in which ratios are calculated, the way in which financial information is represented is again harmonized. So all of that is ensuring more confidence, more trust, easier access for investors in trying to grow. So what we've seen in the recent past, I think, is thanks to an early potential J-curve that one can see in the bond market.
Wonderful, wonderful to hear that. Mr. Sharma, coming on to the, we spoke a lot today about sustainability. Now, with your dual oversight of compliance and sustainability, how can India's corporate bond market better integrate the ESG frameworks? And what will it take to mobilize large-scale capital towards sustainable debt issuance?
See, I'll put 2 points over here. The ESG bond issuance requires having a framework. There is still, as a country, still it is a work in progress. We are framing up the green taxonomy, trying to work out the sectoral methodologies. How do we define green, not green? So we need to speed up that part. If you take, for example, the renewable space, we are roughly 250 gigawatt now. So even if you pick up 200 gigawatt, so the total investment there is 200 into 5, 10 lakh crore. And if it is, you take a 25, 75, 25 equity and 75 debt, so 7.50 lakh crore is the debt which is residing there. This all can be green. So overseas investors are there coming up. So can we have a system wherein maybe under implementation, the overseas investors come and our local bond issuers take over post the asset becomes operational, so that no cash flow uncertainty. This, I think the efforts have not happened. Again, partly the rating related issues. Wherever there are stable cash flows, the bond issuers should not shy away in tapping the local bond market. And see, again, competition is happening with the banks. They are getting easy money, cheap money, so probably they have not thought of the need to go to the bond market. But probably investors, as my colleague was mentioning here, they need to understand the underlying asset, and if it's a good asset, stable cash flows there, and we should not be too bogged down by the rating category. Second piece is that how do we scale up this size? So my sense is, again, probably we need to build up a lot of awareness that this asset class, although may not be getting categorized as a double A, it's a good asset class with these stable cash flows, even if the player is not so big so as to attract a double A rating category, they are good. So these kind of actions at our end probably can help build in large scale bond market. And I think a lot of things has already happened regarding the infra setup. So you have the retail bond platforms wherein people can invest. But someone has to take a lead so that this first gets translated into the issuance, and then probably retail investors can come in.
Sure. Mr. Lakhotiya, coming back to you, let's look at 26, looking ahead to 26 and beyond, and let's talk about the opportunities. So what are the biggest opportunities that you see in the Indian corporate bond space from a private capital perspective, private capital provider perspective?
Shikha, I have 3 words for you. High yield bonds. So basically, as I was mentioning earlier, most of the top rated companies are accessing debt capital markets right now. And if you look at the yields that they are offering, they're really, post-tax, post-inflation, there is really any real return. And that has kept away the retail investors from the market. I believe as more, I would not call it low-rated, I would call it underrated. I have my own thesis for that. But when these underrated companies will start accessing debt capital markets, they will start giving yields in the range of upwards of 12%, which is real positive income post-tax and post-inflation. So I believe as these opportunities will come where you will have fixed income, because on a very long scheme of things, over a larger period, equity returns are also in the range of 14-15%. So if you can have fixed income securities offering similar returns, then there would be a great demand for that. And I believe as an Indian society, we always have had this love for fixed income. हमारे यहाँ पर जब भी कोई अच्छा समय होता था तो हम लोग तुरंत बोलते थे यार एफडी बनवा ले, बच्चा हो गया इसके नाम से एफडी बनवा ले, बेटी की शादी हो रही है इसके नाम से एफडी बनवा ले. So we always had this love for fixed income. It is only that the returns are so unattractive right now that more people are not pulled towards it. I believe we have always considered bonds as a safe parking of money. The moment it will start generating real returns, it would be considered as an actual source of investment. And I believe, when everybody is talking in the same language about REIT, about InvIT and bonds, I feel a little discriminated because debt or debenture is a basic instrument like equity. हम लोग उसके साथ में सौतेला व्यवहार कर रहे हैं इंडिया में. We are afraid of debt. We are negative about debt. Even if an investor loses so much money in equity market, nobody will make a noise. But a single bond, if it is delayed, not even defaulted, if it is delayed, will make a hue and cry about it. So as a society, we need to accept debt more. All the rich countries, all the rich people, they've built their business, they've built their wealth on debt. So this mindset change will come.
Right. So you're saying factor in the risk premium, even if it is like an equity. But there is enough appetite to take at that price itself. And
I'll tell you a similar study and similar justification was given by Michael Milken during the 1970s, where he actually pointed out that, due to the difference in credit rating, the risk return skew which is there to be made money out of. So even though the company are underrated, they are still good companies if you look beyond credit rating. Credit rating is not the only measure of credit worthiness.
so
You're
just
living in a
factor
country which is triple B minus.
Yeah, so price it. You're saying just price it in. Yeah, wonderful. I think that comes us to a more complex topic of the right pricing. Mr. Das, coming back to you, how do you assess the current pricing risk? We are just at the right question. How do you assess current risk pricing in India's corporate bond market, especially for structured or pool instruments, and what can be done to better align investor appetite with these emerging credit classes?
Okay. Before I address that question, let me take off from what Girish was saying. So in my previous avatar as a wealth head and distribution head, I had the privilege of selling overseas products. And while I talked about the fact that we didn't go and sell individual bonds to customers because of the way the market was structured and it's evolving. Let me give you an example of what was happening. So let's take any AAA issuer in the country, right? The rating overseas would be at par with the country rating, right? So give or take triple B. That's the rating that they would get. They wouldn't get more than the country rating, even though one rating agency has changed, the others have not. Now, this company goes overseas, raises money from overseas markets, which is NRIs, and also resident Indians, because resident Indians can do remittance abroad and then invest in these bonds. So let's take a 9% raise. Add the hedge cost for the company, fully hedged, so that they don't have a currency risk. That comes to 12%. Now, a retail investor from India, HNI, wants to invest. So he gets 9%, and this fund will then lever, right? 1 to 1.5 times. 1 to 1.5 times. And I'm talking 9% on the dollar, right? Give or take the currency forward risk, which is 3.5%. Best case scenario, 2.5%. So for the bank, which means the investor is making 12 to 13% on a AAA name in dollar terms. Now, I'm a very savvy investor. I get on a AAA name much lesser in India, and I pay full taxes. But when I invest overseas and I get this money back, it's at cap gains. There is a tax arbitrage for the individual. Why does the issuer therefore go overseas? Because he can raise 200 million at one go. That's what Girish talked about. Private placements are 95, 96% of the market. Price transparency, we don't know. Standardized documents, not there. Covenant breaches, 100 mails come to the trustee. Correct? We therefore need to introspect and find out how can we broaden this market. You know, Bhushan talked about debt being 3.5% of our GDP, right? In terms of overseas, look at markets like US, he talked about it, that number is already there, 110% in corporate borrowings. We are sitting at 16%. Same as mutual funds. Mutual fund GDP ratio is 16, developed market 60%. We're in the same space. But you invest in a bond with 10,000 rupees, you take the risks. If the hot potato were to burn, you carry the risk. But in mutual funds, you don't. You invest in 500 bucks, 100 bucks, whatever you can afford. Now, these are things that we need to think about when we think about pricing. The retail investor is perplexed with bonds. I can tell you this. Being an OBPP, we may have disclosed, we may have given a lot of transparency, we give an IM. But look, I don't give data on static pools. I don't get that data in loans. I don't give him how he's performed in his pools over the 5 years. I mean, in structured instruments, we get the kit document only for the pool, not how the portfolio has performed over 5 years. Now, unless we change this, and unless we look forward and look ahead, and we are, but the pace of change has to be much faster for us to get retail participation. Today, bond markets, we proudly say, oh, you know, we are what? 150,000 crores. Great, great. 67% of the market is AAA, 16% is, give or take, A and triple B. A fintech in the equity space does 8,000 crores a month. Take intraday away, even 3,000 crores a month. One single fintech, and Vijay, you will probably corroborate these numbers. That's the depth of the market in the equity space. Why can't bonds get there? Because there is a gap. $1.5 trillion is your SME loan requirement. How much is serviceable by banks? Sorry, but about half of it, at best. Where does India go to lend? To the haves, which is all of you. But to get to you, I need to ensure we educate you, To get to you, we need to get pricing, because you need to know pricing based on your risk, triple B versus A. And to get to you, we need to standardize a lot more. That's my long response to a question.
Wonderful, yes. That pretty much brings us, in terms of time, I think we'll very quickly go with a quick buzzer round, probably a minute for each panelist, and we can start from there with you. Basically, if we were to suggest top 3 reforms and innovations that would significantly improve the market, what would that be? We can start from there, a very quick 1 minute, 3 priorities.
3 reforms.
Yes, 3 reforms. Or innovations.
Yeah, one would be that, it's actually a banking reform, which I've been saying that every loan to corporates, a term loan to corporates about 25 crores, should be in the form of bonds, even by banks and financial institutions. Reason is, tradable debt is the solution for all your banking woes. You don't have problem of multiple banking, consortium banking. You don't have problem of takeovers. And even you will solve a lot of problems in insolvency. So I believe this way bonds would become this thing, and credit underwritten bonds would be more acceptable than credit rating bonds. That is an important solution. Second thing would be, I would want more companies to be listed in India. We have only 6,000 companies out of 19 lakhs listed total companies in India which are listed. So we should have SME kind of an exchange for anything to raise up to 500 crores. Because the more listed companies we have, the more business will grow. And third thing is, we need to do something to give the same access to debt as we give to equity. Like, you don't have liquidity measures. Even sell side is so difficult. You cannot sell bonds without a DIS. How can you create marketplace where you don't have sell side functionality fully in place? These are some basic things that we are struggling here.
Wonderful. Mr. Sharma.
I will offer
Sense of
2.
3.
So one is that the rating, which I said that we have to move away from the rating-based issuance alone. So unless you resolve that, the large amount will not come. Second is, as you bring down the rating, you would need to set up some funds which can absorb some initial losses. So maybe some funding, sort of some stop loss kind of arrangement, wherein we can have the CDMFs, that one structure is already there. Something like that, for example, particular sector-wise, some fund which is able to absorb so that the retail participation can increase. 2 only for me.
Wonderful. Mr. Chandok.
So I would say 3 things. What can be done to increase access, improve access? I think mutual funds have done a phenomenal job. They don't only do stuff digitally. There's a lot of stuff which happens digitally and through a distribution architecture. So I think some reform, supplement this digital stuff with some reform, because particularly education is also a gap. Can we create a distribution architecture, incentivize, properly regulated regulatory framework, and then create a whole army of distributors on the bond side, supplement it. The second is what can be done to improve education and monitoring the confidence building part. I think just like, again, in the mutual fund industry, the mutual funds are specifically have to earmark some part of their profits for education, investor protection. I think, I don't know if something similar can be incentivized and done there. So whole lot of it. And, continuous monitoring. And there was that observation. We've actually launched a platform which is a DLT-based platform, which does covenant monitoring on a real-time basis, immutable form, makes it available for various stakeholders who want to know. A trustee gets the information and it's all available on an ongoing basis. And then finally, what can be done to get more money bags into the market? FPIs, I think simplification, talk to each of them. And then there is, I think, each one, more pension money, more FPIs, more institutional money to create liquidity and depth. I think there's a lot that can be done in this supply side, in the availability side.
Wonderful.
Okay. When it comes to, I think what we could do better, I think, me included, I think we need to, while we need to educate investors, I think that comes with data. So that's my first D. To Vijayji's point, I think democratization is very key. So if we want retail investors, we need to think about, why don't we think about like ELSS? Why can't we have a DLSS? Okay. The third thing is, of course, digitization. It's helped us as a platform, an OBPP platform, but there are still pockets of improvement that we can do. We're working on it. So bring in transparency, standardization, like I talked about, to spur market growth and depth. And the last thing, I think all of us in this room are onerous towards keeping the client's money intact and safe. And for that, the due diligence that we do, so whether as a platform, whether as an issuer, as a funder, becomes very, very important. So data, digital, democratize, and due diligence, my 4Ds. Thank you.
Thank you. Thank you very much to all the panelists for a very interesting, candid, and good discussion. Thank you, audience, for your attention. We were just speaking that probably attention is the most sought after and most precious thing in today's world. Thank you very much for being patient and giving us your attention.
Hello. Thank you so much, panelists. I request you to please pose for a picture together. Ladies and gentlemen, that was our first panel. Can we have a huge round of applause for all the panelists, please?